And then they asked me, well, what do you think? I said that he needs one thing: backbone. And that's what the problem is. It is difficult. It is difficult to raise rates. Lowering rates is easy. Raising rates is hard.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Wiliam Silber. He's the author of The Story of Silber, which I spoke to my viewers about on a video on July 4th. But today, we're going to talk about his new book, The Power of Nothing to Lose, and the Hail Mary Effect. Wiliam Silber is a senior advisor with Cornerstone Research, and he has a master's and PhD from Princeton University, and he was also a chaired professor at the Stern School of Business at New York University, and he was a senior economist on the President's Council of Economic Advisors, and he was also a member of the Economic Advisory Panel of the Federal Reserve Bank of New York. Yes. And the reason I'm speaking with Bill today is that I did a video about this book back in July, and he found out about it. He contacted me, and we've been in contact, and he was nice enough to send me his new book. I've read it. It's very interesting. And so today we're here to discuss this book and other subjects like inflation and gold and silver. Welcome, Bill.
It's a pleasure to be here, Mario. I've known you just for a short time, but you are a wise man, and I look forward to our discussion. This is the first face-to-face discussion we have, although we have interacted through your very kind comments on the Silver book.
You're welcome. I was curious, which president did you advise on the Council of Economic Advisors? Because it doesn't say on Wikipedia.
Yes, well, so I was on the Council of Economic Advisors as a senior economist in 1969, 1970, under Richard Nixon. And my last day on the Council of Economic Advisors was on a Friday, August 13th, 1971. 2 days before the fateful announcement. So I was there during the planning of that exit from gold, and at that time, interestingly, it was the exit from gold was important, but there were also something called wage price controls in the United States, a freeze. So it was quite a momentous experience.
Yes, I've read quite a bit about that period, of course, and I've read about John Exter, who you might have heard of. And John Exter said that he was in contact with Paul Volcker at the time, who was Undersecretary of Treasury, I think, for Monetary Affairs, and that Paul Volcker asked John Exter for advice, and John Exter said he could do several things. One was to devalue the dollar versus gold. The other one was to raise interest rates. And the other one, of course, was what President Nixon decided to do, to suspend the convertibility of the dollar temporarily, which has been 50 years.
Mario, if we want to discuss that, we're going to have still another video conference, which I'm more than happy to do. But that's a long series, a long discussion.
Yeah, no, that's, I understand. And so let's get on to your book. Yeah, very good book. And I also found out from this book that you were an options trader, and that's what gave you the inspiration to write the book. And me having been interested in options even before I started working in finance and then becoming a futures and options broker, I'm not surprised about this book.
Sure. So first, let me give a sort of a little background as to why I wrote this book, and that will in fact explain its connection with options and also its connection to something we both share, a belief in the power of incentives to determine economic behavior. We are, we have economic views which overlap to some extent, but not completely. But I am sure we both agree that incentives, real incentives, are what causes economic do certain things. So let me give you just a little background. So I've been thinking about this book for 30 years. While I was teaching a course at NYU's Stern School in investments, and the course focused on how investors choose among risky assets: stocks, bonds, real estate, precious metals. But I quickly realized that those same principles of decision making apply to generals, presidents, and ordinary people making decisions based on under uncertainty. And one of the most important consequences is that when people have downside protection, limited losses, and big upside, they tend to take big risks. And the example to drive this home in this class, which was quite mathematical and people were worn down in the middle, I devised a little contest in the last month of class. I said, look, I give them a list of 10 assets: stock, a bond, gold, crude oil, and so on. And I then say, if you pick the one asset that has the highest profit in the last month of class, well, then you're going to get 1.5 points added to your final grade. If you choose one of the others, nothing happens except you get our sympathy. So how should they choose among these 10 assets? Well, some people say, well, I'm going to guess. Of course, that's not a great strategy, guessing. But when they look at this, it turns out that the optimal strategy is to pick the riskiest investment. The riskiest. What's the riskiest? The one that can go up the most and also can go down the most. And back then, for example, it was crude oil. Crude oil can go up 10% and down 10% if somebody sneezes in the Middle East. So you say, well, why crude oil? Well, that will give you clearly the biggest upside. Well, it also gives you the biggest downside, but you don't lose points on the final exam for picking the worst. Therefore, you want the one that, in American terms, you can hit a home run with, the one that has the biggest upside. And by the way, this is the lesson that you learn in options. Options. What do options do? If you buy a call option, you can buy a stock, and if it goes up in price, you get big upside. Well, what happens if the stock goes down? The answer is you just lose the premium that you pay. Well, this is why options on the riskiest security are the most valuable. They are the most valuable because you get paid for upside, whereas you have what I call downside protection. And that's why the power of nothing to lose, when you have nothing to lose, that promotes risky behavior throughout. I'm going to stop now and let me hear where you want to take this discussion.
So why don't we go over the Hail Mary effect? Because I'm aware of what it is because even though I'm not an American, I did go to university in the States for a few years. So I'm familiar with the Hail Mary effect, but for the viewers around the world, could you talk to them about what that is and how it's related to the power of nothing to lose?
Perfect place to start. So the example in the sports world of the power of nothing to lose, at least to Americans, comes from the Hail Mary effect. The Hail Mary pass by a quarterback. So there is a very well-known quarterback in American football, Aaron Rodgers, who is one of the best quarterbacks today. I'm sure most people perhaps have heard of Tom Brady or Peyton Manning. Well, Aaron Rodgers has a better record than either Tom Brady or Peyton Manning because he's very, very disciplined. Throws lots of touchdowns, very few interceptions. However, in the last few seconds of a game, when he is losing by less than a touchdown, which is 7 points, he suddenly becomes a great risk taker. What does he do? He gets into the huddle and says, everybody run into the end zone, and he heaves the ball. That's a pass. He heaves the ball hoping that one of his receivers will catch it and they can win the game. That's a very low probability event, but it is an extremely risky pass because it most likely will result in either an incompletion or an interception. But what does Aaron Rodgers say at this point? Who cares about another interception? Who cares about an incompletion? What I'm interested in is trying to go for the gold, trying to win the game, so I will take a very risky action. So there's a similar analogy in a sport that most people around the world are familiar with, hockey. We know that a team that is losing, for example, by 1 goal in the last 30 seconds or minute of a hockey game will pull the goalie and have another skater to try to win. Oh, this leaves the goal open for the other team to score a goal. Well, what does the coach say? I don't care about another goal. I'm losing the game anyway. I have nothing to lose by taking a normally very risky proposition. What's that? Having no goalie. Why do I do that? Because it's possible that I could tie the game, and at worst, instead of losing by 1 goal, I lose by 2. So downside protection. When you're going to lose anyway, you undertake what is ordinarily a very, very risky action, whether it's the Hail Mary pass in football or whether it's pulling a goalie in hockey, which you would never do under normal circumstances. So downside protection promotes great risk taking. This can be helpful under certain circumstances. It can also cause great collateral damage, and we can talk about both of those if you like.
When you talk about downside protection, and I'm thinking of the Federal Reserve and also the government, all the central banks around the world since 2008, how they've been giving downside protection to investors in the markets. And I think that's causing a lot of collateral damage, economic, socially, wealth inequality wise. Do you want to touch up on that?
Sure, we can talk about that. In fact, there is a name for the downside protection that investors get from central bank behavior. It is called the Greenspan Put. What's the Greenspan Put? Alan Greenspan was a chairman of the Federal Reserve for about 20 years. I'm going to say something now that will surprise you. He was also my student.
Really?
Back to that, if you like. He was also my student. He was much older than me, of course, but he was my student. In any case, what is the Greenspan Put? The Greenspan Put was, as the stock market is collapsing or going down a lot, the Federal Reserve will come in and ease monetary policy to promote higher stock prices. Now, if you ask the chairman of the Federal Reserve whether that is the objective, every chairman would say absolutely not. We're not trying to push up the stock market. We're just trying to keep the economy from collapsing. But of course, that connection with higher stock prices is, if you prevent economic collapse, you promote high stock prices, because what do we know about stock prices? They certainly will fluctuate. But if you have central banks acting to eliminate the downside in the economy, people will start looking at, oh, the only thing that's left is upside, is only good times. And the Greenspan Put, which was discussed in the late 1990s, in fact, has been repeated. And it was repeated in March of 2020, when literally we had a serious chance of having a economic meltdown. The Federal Reserve came in on March 23rd and said, we will buy whatever has to be bought in order to prevent the economy from collapsing. This is what caused, in my mind, the huge rally in stock prices that we've had over the past year. People tend to do what now? Discount the downside. There is no chance that it's going to go down. Why is that? Federal Reserve and other central banks will come in to protect us against the downside.
Yes, and now it's not even cutting rates. It's going into the markets and buying treasuries, and also indirectly, I think, through BlackRock, they're buying corporate bonds. So it's really become a power. Yeah, it's a huge put on for investors, and it's created a lot of troubles. Do you think they'll ever be able to unwind or kind of allow the market to get back to a place where there's normal risk taking, and investors and speculators are actually concerned about falling prices?
That's a great question, Mario. As usual, a great question. Let me be clear. The need for the central banks to come in March of 2020 and protect what I would call a liquidity crisis, I thought was appropriate. I think the central bank had the duty to come in. The central bank is supposed to lend when no one else will. This is the classic, going back to Walter Bagehot in England. So the central bank was supposed to do that, to prevent this temporary panicked demand for liquidity. However, after that has been successfully combated, the central bank is supposed to step back and allow the economy to take its normal course. When should they have stepped back? 3 months later? 6 months later? But certainly not waiting for a year and a half later. That's a mistake. And I have argued elsewhere, and I have this LinkedIn post once a week, which has said it was time for the Federal Reserve to stop buying long-term bonds. It was time, and I think it still is time, for the central bank to raise short-term interest rates, because the world is not filled with zero downside. They had an obligation to step in, and they had an obligation to remove the unprecedented aid that they have provided and are still providing.
Yeah, and if I look back to 1987, because that's when the official Greenspan Put was created, I would say, after the crash in October of 1987. When we look at the Fed funds rate and interest rates, they've been going down ever since. And after each crisis, the Fed funds rates seem to go lower and lower. And then eventually in 08, 07, 08, Bernanke had to start doing QE, which was at the time unheard of. You had to go back, I think, to after World War II when they started doing yield curve control. I guess they were doing a little bit of QE. But my argument is that, yes, they should have maybe stopped 3 months after March 23rd, but they also held off for so long after 08, 09 with the QE. They tried to unwind it, and it created problems. We had the repo crisis in September of 2019. And from reading a lot about history of when central banks or governments go into this policy of inflation, it's very hard to get out of. And my concern is that the institution of central banking, which I'm not a fan of, I'm not sure about you, but I would say the only reason we're here is because there are central banks. Because if we allow the free market and private banks to take responsibility and not have a lender of last resort, and I am aware of Walter Bagehot, and that is, of course, what a central bank is supposed to do. But I would say the people who pay the price are the general public, because we keep getting more wealth inequality and inflation. So you're probably aware of Fiat Money Inflation in France, the book by Andrew Dixon White. The French tried it in the 1790s, and eventually the whole system imploded. Do you think, as you said in your book, towards the end of this book, about maybe gold and silver having to come back, what do you think is the probability, seeing that you're an options guy, of the central banking model surviving this? Because I think it's really hard, because if they start raising interest rates, the whole house of cards will come down, I think, everywhere around the world.
So you have a whole bunch of things in there, Mario, and it can take us. It will take us longer than our listeners will have patience for to finish this discussion. So let me be clear. I think you need central banks, and I think you need them because the alternatives are not as rosy as we think. There were plenty of problems under the gold standard. So we could put that aside and we can make that a subsequent discussion. So I do think we need a central bank. However, central banks have to act responsibly. And when I said in my Silver book that the jury is still out, that's what I really said at the end.
Yeah.
The jury is still out on whether the world of fiat currency will work. Of course, you did have a central bank before fiat currency was out. You had a central bank from 1914 until 1971 with some check to gold. So I do think we need a central bank because the world was not as rosy as we tend to recall. On the other hand, you are quite right that the central bank has to do things that during the time that they're being done, places great stress on a central bank. And there's no greater example of that than Paul Volcker. I wrote a biography of Paul Volcker before I wrote the Silver book. And in 1979, when we had double-digit inflation in the United States and were in danger, perhaps a consequence of going off gold completely in 1971, we had a decade of horrendous inflation. And it took someone like Paul Volcker, who argued, and I'm going to say something about the evils of inflation that I think really get to the core of the evils of inflation. And that is, inflation promotes mistrust of government, because we give the government the right to print money, and we expect the government to maintain the value of those pieces of paper. And that's the reason central banks must act responsibly. And it took Paul Volcker 5 years of pain inflicted on the economy in order to get the inflation under control. And we are still benefiting from that today. And I do recall we had Volcker and I had an interview with one of the radio stations, and they asked him, well, what do you need? Tell us what a central banker needs in order to be successful. And Paul Volcker said, oh, he has to be a good communicator. He has to know some economics. He has to be this and that and the other thing. And then they asked me, well, what do you think? I said that he needs one thing: backbone. And that's what the problem is. It is difficult. It is difficult to raise rates. Lowering rates is easy. And I think that the Fed today is delaying raising rates for the wrong reasons. I'm not sure that the current inflation is not transitory. I am not sure, but I do know that there is at least the same probability that it is going to be secular rather than transitory. And therefore, the prudent behavior of a central bank would be to push up interest rates, not to say, oh, well, we'll wait until 2023, okay? That makes absolutely no sense. So the problem is raising rates is painful, and you have to do it when it is least popular in order to maintain the credibility of the central bank.
Yeah, because they're very keen to cut rates many times out of the schedule of meetings when you have crises. Oh, emergency meeting, Fed's cut rates. But they never come out and say, oh, we've had an emergency meeting to hike rates, which I've argued they should have done this year because we've got the CPI running over 5%. They should have come out and said, we're going to raise the Fed funds rate to 2%. And then I would have said, yeah, that's good. You should be doing that. But unfortunately, if they did that, the whole bond market would have collapsed. And if the treasury market collapses, the US government can't finance itself. Then the stock market goes down the tubes. And then all the IRA pension investments go down. That would be a huge problem. That's why I find it really hard. I don't know how they're going to get away with it.
Well, let me just interrupt one point, and that is, I agree with you. The Fed should have raised short-term interest rates, but it is not clear to me that raising short-term rates would have caused a collapse in the bond market, because raising short-term rates gives people the incentive to believe that inflation will remain under control. And if inflation remains under the control, the long-term bonds will in fact have value. So raising short-term rates could actually turn out to be a stimulus to long-term bonds. We don't know. I don't know, but I don't think, and you may very well get a big drop in the stock market initially. The question is, what's going to happen when people say, this is a responsible central bank? That is certainly a valuable source of support for bond prices, and maybe even in the long run for stock prices. So I agree with you. All of this is uncertain. There's no question. But I agree, we both agree, short-term rates should have already been increased.
Yeah, I mean, and it makes you wonder about Europe as well. They've got negative rates, which is crazy. What about, could we go into what you think about gold and silver? Because there's a bit of frustration in the last 12 months with the gold and silver price, even though looking back through the years, gold and silver and other commodities, they don't go up and down always at the same time. And I noticed that back in the 70s, and you probably know more than I do because I was alive then, but I was only a teenager or even a little boy. I noticed that the price of gold and silver didn't do much from like 75 to around 77, 78. And then all of a sudden it just picked up. So any views on the price of gold and silver, and whether there's still a good hedge to have, not just against inflation, but maybe against mismanagement by the central banks, which I think is, you would agree, we have today.
So we both agree that investors should hold some gold and silver. The question, of course, is how much. I believe that gold and silver act as portfolio insurance. What's portfolio insurance? When everything goes down, they go up. And I say that you should hold 5% of your portfolio in gold and silver. You may say 80 or 90%, but I say it should be insurance. When do you buy insurance? When you don't need it. You don't buy insurance when your house is on fire. You buy insurance and you hold it. So I have in my own portfolio about 3 or 4% in precious metals. And I'm going to, again, go back to an interview I had with Paul Volcker. And he was a little bit, he says, no, I said, listen to me, Paul, here's what I do. I hold 5% of my net worth in gold, and I hope its value goes to 0. And he says, you're right. What does that mean? I hope I'm wrong. I hope I don't need the insurance. I hope that inflation does not take hold, and therefore gold and silver will not be needed. But I certainly think that every portfolio should hold it. And you're absolutely right, Mario. This is not just against inflation. And it's also not just against mismanagement of the central bank. It is broader than that. Every Frenchman knows that you must hold gold because of government instability, because of war that may overthrow a government. In the United States, we don't think that, but we should. So gold and silver, precious metals, are important protection, and I would almost call it sovereign risk. You want something that is supra-governmental. It goes beyond the government. And gold and silver have, and this, you're very familiar with this argument of mine, 5,000 years of recorded history make gold and silver a valuable commodity when nothing else works. And those people who say, well, Bitcoin does the same, I say, it may, but I don't have more than 10 years of experience, if that. And I'll take 5,000 years of experience over 10 years. So that's why we have an agreement about you must hold gold. How much? Well, I take it as a portfolio argument. You take it in a different way. We can agree to agree as well as to disagree. The role, in my mind, for precious metals, and I think you should know. No one should leave home without a bar of gold buried in the backyard. That's that's what someone's French grandmother said. Don't leave home without a bar of gold buried in the backyard. So I think that is that in fact is the case.
So the other question is more to do with the currency and hyperinflation and the petrodollar a little bit. We're seeing, for example, that I think Russia and Saudi Arabia, they signed an agreement a few weeks ago for military and economic cooperation, and a lot of people took that as maybe a challenge to the petrodollar. I saw today, I think it came out yesterday, that Indonesia, which is almost 300 million people, they've just signed up an agreement, their central bank, with the People's Central Bank of China to do every trade transaction in their individual currencies instead of the dollar. Yeah, do you see that as a problem?
Let me just say that I just had I think I mentioned I have a LinkedIn account where, and you know this because we look at each other's. I just had a post where I discussed whether the Chinese yuan will have a chance of dethroning the dollar as international. We talk about international reserves. I call it international money, and the role of China as a export powerhouse has occasionally brought up speculation by smart people that the yuan or the renminbi, however you want to call it, can challenge the dollar as international money. And I say there's no chance of that. There's no chance of that because if you look most recently at the Chinese regulators who have attacked Alibaba and Tencent, and more recently the educational technology sector, it seems that the yuan, the Chinese regulators, make up the rules as they go along. Whereas in a place like the United States, regulators are constrained by laws. And the most important characteristic of the US dollar as international money is that we are a country of laws. And that belief that we are a country of laws allows people to say, I can put money in and withdraw it without fear that the government will suddenly change the rules. Having said that, there's another important characteristic of the international medium of exchange, and that is, it is a good store of value. And if inflation tends to take hold way before hyperinflation, inflation takes hold in the United States, that will undermine the dollar's role as international money, and they impair the dollar's exorbitant privilege that Americans have enjoyed. What's the exorbitant privilege? We import cars, we import clothing, we export green pieces of paper, which other people hold because they view that as cash balances, which will retain their value. We almost lost that advantage in the 1970s. The dollar in the 1970s was viewed with great suspicion. And once again, early of 80s, when the United States conquered inflation, saved the dollar. So we need a nation of laws, which we are, but we also need a responsible central bank that will give the dollar the same credibility that it has had. And I'm going to paraphrase Winston Churchill. The dollar is the worst currency, except for all the others. That's what Winston Churchill said about democracy. It's the worst political system, except for all the others. So we need a central bank that is responsible to keep the role of the dollar as international money.
Yeah, maybe maybe gold and silver will make a comeback, because I personally don't see that changing in the near to medium term. But before we finish, can you tell the viewers where they can get your new book?
Sure. The Power of Nothing to Lose, the Hail Mary effect in politics, war, and business. I'll call, they can't see the color, the people on the cover, but I'm just going to list the people on the cover. There's Rosa Parks. There's Donald Trump. There's Green Bay Packer quarterback Aaron Rodgers. There is George Washington and Adolf Hitler. What do all these people have in common? And the answer was, and you will see it in the book, they all confronted downside protection. Go to your favorite platform, Amazon, Barnes & Noble, and so on. Read the book and write a review of what you think. I look forward to hearing what you say.
Thank you very much, Bill. And hopefully we will be talking again in the future. Maybe we could talk about the day you resigned from the Council of Economic Advisors just before Nixon's shock.
That's an interesting period. I will be happy to come back on, Mario. It's a pleasure talking to you.
It was a pleasure talking to you too. Thank you.